Content is intended to provide accurate information, however, is not intended as financial, tax, or legal advice. Please consult a financial, legal, or tax professional for specific information regarding your individual situation. Opinions expressed and provided are for general informational purposes only and should not be considered a solicitation for the purchase or sale of any security.
Cornerstone Retirement Partners presents Your Course to Retirement with Grand Rapids Certified Financial Planner Ron Corser and Nolan Gosley. Cornerstone Retirement Partners are planning today for the potential of tomorrow.
And welcome into the program. This is Your Course to Retirement, brought to you by The Resource for a common sense approach to planning for your financial, your investment, and your retirement future for so many Grand Rapids area savers and investors. The team from Cornerstone Retirement Partners and founder, CEO, and CFP, Certified Financial Planner, Ron Corser, is here with us today. Ron, we always appreciate your time.
Good morning, Peter, and good morning, everybody listening to today's program. We're going to have an interesting discussion about some things that sometimes we overlook, but I'm going to start with this real key question. We're right in the middle of football season. Yay. I'm really happy about that. And you know, in football, like baseball or hockey, any kind of sport, the question always becomes, how do we define success? And success in sport really is, did you win the game? Did you win the league title? Did you win the conference? You know, if you're a golfer, did you win the tournament? There's always a way to measure success. And it's easy that way. When it comes to what we talk a lot about in this program, retirement planning and retirement income planning, it's not as easy to measure success. And why do I say that? We don't know, for example, if we create an income plan for somebody in retirement, which we've always talked about as being the single most important thing you can do in terms of retirement planning, is you create the income. So you know if you have enough income, and hopefully you do, to retire. Because if you retire, you don't have enough income. Does that make sense? No, it doesn't. But let's assume that retirement income is the key. But sometimes we don't know how good that plan is until we have a major downturn event. I'm not talking so much a zombie apocalypse, but something bad. And so I go back to what happened in 2020 in the first quarter. In March of 2020, if we recall, they shut everything down because of COVID, and the stock market went down about 31% in 22 days. And it was looking like that was the beginning of a really ugly bear market, potentially the kind of market that we experienced in 2008 and 9. Fortunately, it was more of a V-shaped thing. The government turned on the money printing spigot and kind of bailed us out short term. Long term, we still don't know how that's going to work. We all have a sense that, man, maybe this isn't going to be so good. But for right now, the market's still up. So a lot of investment plans and income plans were impacted somewhat by that. If it was a good income plan to begin with, what we found is that it still works for our clients. The income plan we created in 2018, 16, 14, reviewed in 2019, whenever, the income plan made it through that catastrophic short-term event. The question becomes, is that going to be good enough going in the future? How are we going to define success? Well, we got a little taste of it, but frankly, in our business and our planning, we really can't define success as if we're looking at a football game. We have to wait until the zombie apocalypse happens and hope that we're in good shape for that. You know, Ed Slott, one of the people that we're affiliated with, and our firm is one of the master lead advisors for Ed Slott, who's the big 900-pound gorilla in the IRA retirement world. He defines success as, you know what, it's like a football game. It doesn't matter what's happened in the first half, the first 2 quarters. It always is key of how we finish. What's the score at the end of the game? And for a lot of us doing retirement planning and helping clients with this, we always are focused on that end result. And a lot of it is built on hope. But what we can do in retirement planning is focus on, okay, what happened in the first quarter of 2020? What happened to your income plan? What happened to your investment plan? Did it come off the rails? Did it get blown up? And a lot of times people say, no, I did okay. I'm back to normal or a little bit above. but we really have to look at that time frame. What happened to your plan? So in going forward today, we're going to talk a little bit about defining retirement success in terms of your financial plan. And we're going to talk about a couple key, what I think are key additions or things that somebody should at least look at when creating a retirement income plan. And those are really serious issues. How do we make sure this thing's going to work? Because think about this. If you're retiring this coming Friday, you're going to be retired. You may be in retirement 30 to 35 years. We're living longer, and people say, oh, I'm not going to live that long. We say, we don't know what God's got in store for you. You may live a whole lot longer than you want, and you always want your money to last at least one day longer than you. So how do we do that? We know, for example, that if we make a full bet, 100% in the market, we're going to be in times of trouble, and we're going to be in times of good times. We're going to have some success. You know, the market has been pretty good since the COVID issue last year. But when we look at a long-term, 10 or 15 or 25 year results of the stock market, it's not been as great as everybody thinks. So how do we define success? Well, part of defining success is figuring out how are we going to create a plan in retirement that gives us all the income we need in retirement so we can maintain our lifestyle. That's always the key, isn't it? So we can maintain our lifestyle and do the things we want. Now, there's a lot of different things we can put into our retirement plan. Bank CDs, money market funds, stock market-based things, bonds, all kinds, treasury, what have you. Some of the things that we sometimes overlook, because I think a lot of negative comments have come from people in my industry on life insurance kinds of accounts. Because sometimes we don't fully say, well, what is the purpose of why I'm investing in a different kind of thing? So here's what we're going to talk about today. We're going to talk about using life insurance, using principal protected annuities as a potentially something that might make sense in a retirement plan. Because at its core, discussing different things to consider makes great sense. But at its core, any insurance is really simple. It's a form of protection, isn't it? So we have car insurance, we have long-term care insurance, we have health insurance, we have life insurance, we have disability, all of that. It's all protecting us against something that is potentially a catastrophic event in our life. We know that if we don't have the protection for it, it could ruin our retirement income plan and ruin our retirement. We know that. So let's take a look at this part of the retirement income plan universe, if we will, for this program. We've talked a lot about investment products. Let's focus today on insurance products. And there are really two kinds. There's life insurance, and there are what are called principal protected annuities, or even variable annuities, which we don't use very often. So annuities and life insurance, they're all considered, number one, life insurance contracts because they have a guaranteed death benefit. So anything with a guaranteed death benefit is life insurance. Now, there's a lot of people who subscribe to the concept and the idea that, look, life insurance is just income protection. After 60, you should have enough money to self-insure and you should be okay. I have no idea what self-insure means. It means that you better have, I guess, a lot of money in case terrible things happen in terms of long-term care, dying with a lot of debt, things like that. We can imagine all the bad stuff. So I don't know what that means. So let's just push that aside. Let's just think of, we have a lot of risk in our life. We know that driving a car is risky, not because we're bad drivers, but because the other guys are bad drivers and we have to look out for them. So we have car insurance. We know that we have to have health insurance because stuff happens. We're not always perfectly healthy, so we have to have that. We know, for example, that in some way, somehow, we have to protect ourselves and our family from death of an income earner that impacts the family, particularly if you're younger. It also has an impact if you're older. We know, for example, that half the people listening to today's program is going to need some sort of custodial care, meaning long-term care in their lifetime. That's just statistics. That's all it is. Half of everybody listening. So if you're driving to church today look at your spouse and say, you're the one going into the home. I'm not the one. I'll come visit you and bring you M&M peanut candies. So we do all of this to protect ourselves, but a lot of times we overlook the opportunity to protect our financial income plan. So how do we do that? Well, let's think about what impacts our financial plan. No matter how good you may have created it in the beginning, where's the risk? The risk comes in a couple of places, and we're going to talk about the risk. So what I'd like everybody to do, if we're touching on something that's important to you right now, give us a call at 616-301-2581, 616-301-2581, or go to our website, Cornerstone-RP, and put in your name, put in a question, or say, look, I got some concerns about how I'm going to handle this long-term risks that I'm facing in retirement, which are very similar to the long-term risks we face when we're working. I want to make sure I don't get upended or get banged for the bottom and not know what to do, or it's going to impact my plan. Again, 616-301-2581. So talking about risks, let's touch on first life insurance. And I go back to when I first got in this business in 1994, and I started out by selling life insurance. And that's when you have the mark of 666 on your forehead, I think, with a lot of people, because I couldn't even get good friends to have coffee with me like they used to when I was not in this business, because they always thought I was going to bang on them to buy life insurance, and that wasn't true. But what does life insurance do? Most of us think, well, there's only one kind of life insurance. It's just going to protect somebody if they die. But there's a concept called living benefits with life insurance that are quite often overlooked. They really are. So think about this. What are the risks that we take a look at that perhaps life insurance can help us mitigate or take care of? Number one, obviously, is the issue of dying. So for example, I have life insurance on my own life. My wife, Nancy, has life insurance. Why do we have it at this stage in our life? Well, we have it for a couple of reasons. Number one, we may live a long, long time. And the life insurance contracts that we have are cash value mostly. I do own some term insurance, but it's designed to provide additional assets should I die before my wife or my wife die before me. There's always going to be a need for additional assets, more money. You know, there's some people on radio now and TV that always talk about, you know, you don't need it after 60. And, you know, you should just dump it or just buy term and invest the difference. And it gets down to what's the purpose of the insurance. So for example, if you have a short-term need, you want to protect your child's ability to go to college and be fully funded. Well, maybe you want to get a term life insurance product for 10 years just to cover that. A lot of it has to do with what's the purpose of the risk that you're trying to mitigate or to slow down or to eliminate in your life. So my wife and I have it. Why? Because we want to make sure that who's ever still alive after one dies, we have other things that we want to take care of, our own needs, our own children. We have legacy issues that we want to provide for kids. There's a lot of things we do. And some people who say, well, you don't need it after 60, I would debate with that person all day long. I've been doing this since 1994. I have never in my whole life had somebody die who was a client who had life insurance. And when I've gone to the spouse, the widow, and say, here's the life insurance because your husband died, I've never had anybody say, no, Ron, I don't need that. I don't want that money. Just cancel that. Never said that.
Ron, so, can I ask a question? Does having that life insurance in place on each one of you, does that give you more confidence in living your life and to the fullest together, to be able to spend some of the money that you've worked to build and create together, knowing that you've got that bucket there to sort of refill the dollar supply?
Absolutely. It's a great lead in and a great question. Yeah, we're comfortable. We know that we've covered a lot of things because some of the life insurance that we have covers some of the risks that we have in life that we're going to touch on going forward. So far, I've just touched on the death benefit, but absolutely, it gives us a comfort level. Do we pay for it? Yes, we do. But in my perception and the way I think, it's like taking a few pennies on every dollar to maximize a benefit, to leverage that benefit. So we've used it a couple ways. One of the great ways that I used it earlier, when we first got in business, we had cash value life insurance. And we took out, one of the things you can do with cash value life insurance is you can take out income, so to speak, tax-free income for cash. And one of the ways we helped fund our early going in our business was the use of life insurance, because nobody in the bank was going to lend me money starting out this business in the financial world. So tax-free income is a real benefit of cash value life insurance. It helps with people like me who are in business. But the other issue that we have it too, so that it will provide tax-free income for us going forward. We've said a lot of times on this program that probably taxes are going to be a whole lot higher 5, 10, 15 years from now. I mean, right now, they're already talking about raising taxes, even though they promised not to in Washington, D.C. It's going to happen. So the more tax-free money, the more tax-free accounts we can create in our retirement income plan, the more secure our plan is going to be. So one of the things I caution people is don't just because you heard something or thought of something, just say, I heard this is bad or confusing, I don't understand it. Don't discount any asset class or any kind of account that you might use in retirement that could be to your benefit. So thinking about all of this, give us a call at 616-301-2581, 616-301-2581. We can help you go through different kinds of accounts, different kinds of products to see what makes sense for you. You know, we've been taught a long time ago, my mom always used to say, and everybody knows, don't put all your eggs in one basket. It's not any more difficult than that to say, well, I know I got to have some money in my retirement plan in the stock market. I need to, but there's a risk there. I'm needing to have income. So how do I balance all of that? You have more than one basket, ladies and gentlemen, to put some of your retirement money into so that it does different things for you. So life insurance, here's what it does, cash value. And you're never too old or you're never too young to get it. Number one, yes, it gives you, there's a benefit if the holder of the insurance dies. But more importantly, there's a couple living benefits that are incredible. One is it can be written in such a way and allocated in such a way that you can get lifetime income that's tax-free out of it, that'll last longer than you, that you can never outlive. That's a great benefit. The second benefit of life insurance, and particularly in today's world, is it provides a long-term care benefit. Now, how does it do that? Well, there's these new life insurance policies that have come out in the last 10 years. The insurance companies have recognized that we're living longer and custodial help is more and more prevalent, more and more needed. But man, it can cost a lot of money if you have to have somebody come into your house to help you out because you can't, get out of bed easily, you can't bathe yourself and things like that. But to have long-term care insurance on an individual basis, those policies, most people say, wow, they're really expensive. And yeah, I would agree that they cost a little bit. But the concept behind those individual policies is a use it or lose it. Meaning, if you never get in to go to the nursing home or have a long-term care issue, it'll never pay out. And sometimes you can joke and say, well, if you never had to go in a nursing home, would that be a bad thing? But people still don't like the idea about just paying for something and never using it, like health insurance or car insurance. So one of the things a great life insurance contract, a cash value contract can do, is it can be created in such a way to provide what we call, they won't call it long-term care, they'll call it a chronic illness or something like that, but provide cash for you if you need long-term care, not only in a facility, but some of the policies are even if you for care in the home. So it's a way of taking a portion of your life savings and saying, there's a couple things I need to do. I need to protect my family if I die. I need to protect my family if I have a long-term care issue, particularly if I don't want to go into a nursing home and I don't want to spend down all my assets to take care of myself. So that's what a long-term care benefit can do built into a life insurance contract. So there's two things it does really well. Actually, three. There's a death benefit. And importantly, it gives you tax-free income if it's structured properly, and it gives you a long-term benefit. So if this is something that's interesting to you out there listening, give us a call. We can help go through how a life insurance account, how that kind of a strategy for a portion of what you're doing in your retirement plan can be perhaps valuable to you. Give us a call at 616-301-2581, 616-301-2581, and we can examine and kind of explore all the different options there are. It's not just simply, well, here it is or there it is. It has to be tailored to you. And we're capable and able to do that to see if it makes sense. So give us a call, 616-301-2581, and we can kind of have a great discussion on the whole idea of life insurance. Does it make sense for you? Does it not make sense for you? It used to be a long time ago when I first started selling life insurance and I couldn't even get my friends to have coffee with me. Sometimes I would ask people, if life insurance was free, how much would you want? If life insurance was free, how much would you want?
All of it.
That's a great question, isn't it?
Yeah.
And I'd want a lot more than I have. I really would. And here's a little aside on who's the biggest owners of life insurance. And this is, think about this. Sometimes we think, well, this is a really wealthy person. He must be great at investing. I'm going to do what he told me to do and buy what he told me to do because he must be really wealthy and knows what he's doing. You can debate that. But the other issue, you know who the biggest buyers? There's two really big buyers of life insurance. Number one are the really wealthy people. They're the biggest buyers of cash value life insurance. Why? Because they understand the incredible benefit of life insurance providing tax-free income over time, if it's properly structured, a long-term care benefit, and also tax-free benefit for legacy planning. The other great holder of cash value life insurance are our banks. They're allowed to have a portion of their liquidity requirements in cash value life insurance. And they would have more if the government allowed them, but they don't. So, sometimes we want to take lessons and take advice from really wealthy individuals. I'm always amazed at the idea that if they're doing this with life insurance cash value, why don't I at least take a look at it to see if it makes sense? So give us a call, 616-301-2581. 616-301-2581. We can explore this really important topic with you to see if it makes sense for you. Now, here's the key. Once you go through the examination and you give us a call, you still are allowed to say, no, I don't want it. But you'll never be in a situation where down the road you say, oh man, I wish I'd have done something about this. So give us a call at 616-301-2581. Go to our website, Cornerstone-RP. We'd be more than happy to help you.
Cornerstone-RP.com, Cornerstone-RP.com, or again, give a call, 616-301-2581, 616-301-2581. Ron and the team from Cornerstone Retirement Partners do offer the opportunity for a complimentary, comprehensive review of your investments, your financial, your retirement plan. If you would like to get that plan put together, the Course to Retirement plan, or if you would like a strategy session to review and update your current plan, pick up the phone and give a call, 616-301-2581, 616-301-2581. Ron, you made a statement that it's not until a downturn that we will know if the plan works. Isn't that very much in contrast and contradictory to the mindset that most investors have of shooting for the highest returns? And isn't that in essence the same confidence that any form of insurance gives us, that we know that we are protected when those downturns do occur?
Yeah, that's a good point. We do sometimes think that what happened yesterday in the stock market is going to happen today and tomorrow. Most people think that the market has returned 10 or 15% over the last 20, 25, 30 years, because that's been the rate of return, say, over the last 24 months. And what's amazing is that sometimes as human beings, we do it. I do it, you do it, we all do it. All God's children do it. We tend to say, well, it's been going up for a while. The market's at all-time high. It's going to keep doing that. Except there'll be a time when it doesn't. I don't know when that time's coming. I really don't. But a lot of people out there are very, very nervous about what's going on today, both of what the government's doing, the economy, and world events. And that means there must be a heightened sense of risk. So the question becomes, how is your portfolio going to perform if the market has a prolonged decline? Now, we were fortunate last year in 2020 that it was more of a V-shaped recovery after March. Well, let's go back to the last big blow up in the market, 2008. That one lasted from September 15th to March 9th, 2009. And that was a long time. The market did ultimately go down by half. I've met people since then whose retirement plan was absolutely destroyed because everything was linked to the market, and that's the way the market was going. And remember, people always say, well, don't worry about the downturn because the market always comes back. And guess what? It did come back. Except if you lost 25, 35, or 45% of your retirement money in 2008 and 9, you haven't come back. There's not enough money in there to come back on. So think about this. If we have a 20% drop in the market, which is not out of the ordinary, I mean, that would come maybe once every 5 to 10 years. The market has to come back 25% to just get you back to even. But here's the key. Here's the thing to remember. If you're taking money out of your retirement plan and you have a 10, 15, or 20% loss, it is really going to be difficult to come back to even because you're taking money, so to speak, you're taking income monthly, annually, however you're doing it, out of a well that's kind of drying up. It's very, very difficult. We've talked about that, is sequence risk. So one of the ways to kind of buffer your retirement income plan from this sequence risk is to take a look at some insurance products, because insurance products in their simplest form are a way to take a risk away that could hamper or even destroy or cripple your retirement plan. So we've talked a little bit about life insurance, how it helps with cash flow, legacy issues, long-term care issues, which are bigger and bigger things to worry about. So give us a call, 616-301-2581, 616-301-2581. We're going to talk more about this, and we're going to talk about another insurance product called an annuity when we come back from our break.
Again, the number to call, 616-301-2581, 616-301-2581. That call will allow you to have a conversation with a qualified, experienced team of financial professionals to set up a time for a detailed discussion of your situation, to get that complimentary review, to get that plan put in place, the course to retirement plan, looking at your income, your investments, your taxes, healthcare, legacy, and the protections that you have in place for all of those. Pick up the phone and give a call, 616-301-2581, 616-301-2581. Quick break. We'll be back with more with Ron Courser, Grand Rapids Certified Financial Planner, here on Your Course to Retirement in just a moment.
Cornerstone Retirement Partners presents Your Course to Retirement with Grand Rapids Certified Financial Planner Ron Courser and Nolan Gosley. Cornerstone Retirement Partners are planning today for the potential of tomorrow. Visit cornerstone-rp.com for many valuable resources, including those mentioned on this show and other great episodes of Your Course to Retirement.
Welcome back to Your Course to Retirement. Grand Rapids, your resource for a common sense approach to planning for your investment, your financial, your retirement futures, and your resources are there at Cornerstone Retirement Partners. With us today, we have certified financial planner Ron Courser, and we are talking about adding protections to your financial life, protections in the form of life insurance, protections in the form of annuities, what these things do, how they work, the pros and cons, when, where, why to consider them as part of your plan and part of your portfolio. Ron, we talked a little bit at the beginning of the first segment about how insurance works, and that at its core, insurance provides us a protection against financial loss, or the possibility of the loss we would incur if a catastrophic kind of event happens. What people may not realize is that you can actually insure the value of your portfolio, and they may not think of it like that. But a simple example is that you could put your entire portfolio in a bank or in various banks, and that would essentially be insuring its value. Now, the cost of that is the upside potential that you might lose out on. But that is a form at its core of insurance against loss of value in your portfolio. Now, there are other forms with insurance and annuities and In fact, we can even ensure our retirement income and make sure that that's always in place regardless of circumstance.
Yeah, it's a really great concept to think about it, is we can keep all our money in the bank, and if we do it, make sure we don't have too much money in any single account. Yeah, we can get that FDIC insurance. What do we give up? Stock market gains, inflation issues, but our dollars are going to be there. They may not buy as much 5 years from now, but it's there. And I, as a certified financial planner, I encourage people to keep some of their portfolio money into bank accounts, just because it gives us some protection and it gives us some peace of mind, so we can go in the middle of the night at the ATM machine to get out money that we need for any kind of emergency or thing that we want to do. So I think it's another place to put money. It's another bucket, so to speak, in that retirement plan. So because it provides some protection, it gives us some peace of mind. So there's another kind of an account out there that can be put together to do that same thing, to give us protection and give us some peace of mind. And that's called an annuity. Annuities have been banged around for years. I think probably they get worse coverage than life insurance because of whoever is saying, I would never do that. Those are terrible investments. There's different kinds of annuities. There's an immediate income annuity. What's that? Social Security is a great example, or a pension plan is a great example of an immediate income annuity. They're going to pay you money once you qualify or push the button. They're going to give you money for as long as you live. No questions asked. Hopefully it'll work. There's a deferred annuity. That's where money's put in either by you or your company, and you defer taking income out until a later date. There's two kinds of other annuities within that deferred category. One is a variable annuity. That has just a lot of mutual funds in it. You can see the fees in that. This is what creates most of the bad press, I think, from my point of view, on annuities, for people who say, don't do it, I hate them, and what have you. The other kind of annuity is what's called a fixed annuity. It's just jargon. It's a principal protected annuity that's deferred, that can be used to create a lifetime income stream, sometimes even with a cost of living kind of rider in it, the money that you can never outlive. You live to be 150, they still pay you money because it's an insurance company that issues these contracts. And yes, I'm allowed as a financial advisor to use the word guarantee when I talk about bank money, FDIC insurance. And when I talk about fixed annuities, I can use the word guarantee because yes, there's 3 levels of guarantees on that. Your principal is protected. And the annuity that we use mostly in our firm here, and I own them myself, is called a fixed indexed annuity. It's just another insurance product that gives a guaranteed death benefit. It can be structured in a way to create lifetime streams of income that we cannot outlive. My wife and I cannot outlive. And the other great part about this is that if I die, my wife gets it. If she dies and there's still money left in these contracts, our children and grandchildren get it. You never lose control of the money. So it's a real key part, I think, of building a retirement income plan, is to take a look, yes, at life insurance, obviously, but this other insurance contract called an annuity. And I'm going to focus for the rest of the program on principal protected fixed annuities or fixed index annuities, as opposed to the variable annuity. A variable annuity is nothing more than another option for the life for investing in stock market stuff. Annuities do one thing better than other, whether it's variable or principal protected. They're designed to provide income that you can't outlive. But the variable annuity is really just another stock market option. We're going to focus on the principal protected options, which I tell clients or potential clients when we talk about them in our office. The fixed annuity or principal protected annuity is it's another option for bank money. It's not an option for the stock market. There's a lot of people on radio, a lot of people who sell this as this is a great stock market alternative. No, it's a great alternative for the bank money that used to pay us 3, 4, 5, or 6% a year. And if we put money in there, they'd give us a toaster. Remember those good old days? Well, that's probably not going to happen for a long, long time, which is why we tend to take a look at whether any of these kinds of insurance products, life or the annuity, makes sense for a client. And we're not one of those firms that say you absolutely must do it. We're a firm that says, here's the things that it does well. And since there's no perfect investment, ladies and gentlemen, the stock market is not a perfect investment. We tell them what it does well and what it doesn't do well, because it's not perfect. We tell them how it can add to a portfolio, particularly when it comes to creating income and retirement. And that is the entire key of creating an investment or retirement plan, is how much income can I generate from my life savings to make sure I have enough income in retirement to retire comfortably. So properly structured, a principal protected fixed annuity can answer a lot of questions in terms of how do I get protected income that's not going to go away if I have a stock market correction, if I experience something terrible happening in the market. It's guaranteed income, guaranteed cash flow. So if this is of interest to you, to just learn more about this, come and see us. Give us a call at 616-301-2581, 616-301-2581, or go to our website, cornerstone-rp.com. Put your information in there. We'll be glad to answer your questions or set up a very informal one-on-one kind of discussion or talk, and we can answer your questions on these different kinds of accounts that perhaps will make some sense. But the real key issue is once you understand how they work, you'll know if it makes sense to you to have them as part of your portfolio. And the good news is you may be in a situation where it doesn't make sense, but wouldn't it be wonderful to know that? That's what we can help you do. We can be clarity to this whole thing so that you're not confused. You don't feel like, I tell people about the 11th commandment. 11th commandment is thou shalt not let thyself be buffaloed. And what we help will make sure you're not buffaloed. So give us a call at 616-301-2581, 616-301-2581. Go to our website, cornerstone-rp.com. We'd be more than happy to help you. Give us a call or contact us.
616-301-2581, 616-301-2581. And what an annuity can do at its core, its principal job is insurance for your retirement and your lifetime income. It can provide guarantees that that income will be dependable, durable, last as long as you need it to, and one day extra. But a recent article, Ron, from Wealth Management actually highlighted Robert Ibbotson, who argued that fixed and fixed indexed annuities, those principal protected annuities, can actually also serve as a substitute for bonds in an investment portfolio because of the low interest rates we're seeing, because of the low yields that bonds are generating, because of the inherent danger to principal. Your principal in a bond or a bond fund is at risk. And because of the fees associated with bonds and bond funds inside of a managed portfolio, fixed and fixed annuities often help to improve the outcome and the outlook for a portfolio, lowering risk, lowering fees, and increasing the income that the portfolio can generate.
That's a really good point. And it's a great example of what somebody who really is outside the normal stream of just being in the financial services, or he's a consultant, but he's a highly regarded person when it comes to dealing with financial issues. And I will say this to everybody, if you'd like a copy of this article that he put out, give us a call, 616-301-2581, or email us on our website, cornerstone-rp.com. It's just called Ibbotson with Fixed Index Annuities Beat Out Bonds. It's a great 4-page article. We're glad to send it to you. He is, we talk about experts, right? What's an expert? I tell people an expert is somebody that's more than 200 miles away from where you are and charges $1,000 an hour to give you advice. He's an expert. He really is. And he's done a major study comparing use of bonds in a portfolio to the use of an indexed annuity in a portfolio. And it clears up a lot of misconceptions, because a lot of what we hear when it comes to this kind of an account is, oh my goodness, why I would never buy one. Why I wouldn't sell you one in a million years. We have people in this industry who advertise that way. We have people on the radio who say, don't ever do that. And they never really talk about the data behind it. So this is an article that really does talk about the data for almost 100 years behind the use of these kinds of things. And it'll be a real great article for you to take a look at. Because what it really says is, look, it does two things really well, these principal protected annuities. It can give you a better rate of return over time versus bonds, but it's safe and secure. It's principal protected. The worst outcome you can ever have is 0% interest per contract year. That's the worst outcome. You will not lose money in these accounts as long as you follow the contractual agreement, and it can be set up to provide lifetime income even on an increasing basis. So sometimes when people understand the risks involved in creating a lifetime of income plan in retirement planning versus what are we going to do to make sure this thing doesn't fall apart, not 3 minutes from now, but maybe 3 years from now, 5 years from now. This is a great piece to talk about. So give us a call. If you'd like this article, I think it's a great article. It'll help kind of put some of the other stuff to the side. 616-301-2581, 616-301-2581, or go to our website, cornerstone-rp.com, and just say, I want that article that Ron talked about, the Ibbotson article on indexed annuities, how they beat out bonds over the long term. So give us a call for that.
However, Ron, I'm going to go back again to what you started the program with and saying that it's not until a downturn that we'll know if the plan actually works. With including these as part of our plan, these vehicles that protect against those downturns, we can put a plan in motion that we will know works through one of those downturns. So we can be proactive in avoiding the damage that a downturn could cause us.
That's very true. I'll talk about our company put in a 401k plan in 2005. And I did it for two reasons. Number one, I wanted to have a Roth 401k provision. And at that point in time, not many firms would do that. And the other part is I wanted to use a fixed indexed annuity, a principal protected annuity, as the primary investment vehicle in a 401k. Now, I've had this since 2005. And I can document and prove to you that in my 401k plan, I have not lost a penny since I started putting money into the retirement vehicle in the fixed indexed annuity. Did I miss out on some 30% years? Yeah, I did. But you know what? I missed out on 2008 and 9. I missed out on 2018. I missed out on what happened in the market last year with COVID. I missed all the downside. The worst outcome I ever had in a given year was 0% gain. I never lost that. And my wife has done the same thing. And so have a couple of our employees here. So it's not something that I just say, I think it works. I know it works. It's worked in my plan. But understand this, it's not a substitute for the stock market. It's a substitute for the old time bank money. They used to pay 3, 4, 5, 6% and give you a toaster. When we created the plan, my wife and I talked very clearly what we wanted to have it accomplish. And one of the things we didn't want to have happen was to lose money. The second thing we wanted to have happen was have gains. And so we've experienced both of it. It's a way, and now that one of these days, if we ever retire, we've got enough in these accounts. We've owned about 4 different annuities. We got enough income in retirement to retire. And we're not wealthy gazillionaires and we're not extravagant people we spend, but our income plan is in place with this. So I don't worry about the money we have invested in the market. We do have some. Yeah, I don't want it to go down, but market-based risking has risk to it. But in terms of our income plan or retirement, I don't worry about that. That's in place now. It's fixed. It will go up over time. That's one of the advantages of taking a look at this kind of an account. Now, is it right for all your money? Absolutely not. I'm not sure anything is right for all your money. And I know there's people out there that tell you to put all of it in there. I'm not one of those advocates. What I do advocate and encourage people to do is to say, look, there's a lot of different baskets we can put our retirement money into. Life insurance, cash value, and annuities, fixed income annuities, indexed annuities of any kind. They're appropriate to at least look at because they do something that the stock market doesn't do. It can't guarantee you lifetime income that you can never outlive. A stock market can't do that. You could have $1 million and I suppose you only need to take 5,000 out a year because why? because you've got a couple pension plans and you've got Social Security. You've already got that protected income coming in for as long as you live. So most of us don't have that. We don't have pensions. And the use of a fixed index annuity can be a substitute for bonds in our portfolio, and can be a substitute for that pension plan that we wish we had, that we don't have, because it will create income that will stay steady, that will continue for as long as you live. But here's the great thing about it. One of the concerns I hear when people say, well, I've heard annuities are kind of strange or bad because if I die, all the money goes away. That's called an annuitization. That's just a big $5 word that says you give all the money to the insurance company, and like a pension plan, they guarantee you money for as long as you live. Well, we don't often do annuitizations. I think since I've been in this business in 1994, I think I've done 7 of them. They just happen to serve a particular purpose. What we do use is the income account value and the option that these principal protected fixed index annuities have, where you can still get a stream of income out of them. But if you die and your spouse dies and there's still money left over, it goes to your inheritance, your children, grandchildren, a charity, whomever you've designated as your beneficiary. You never lose control of the money. So that's another aspect of it. I'm somewhat of a control freak, I guess. That's what my wife says. I don't like to lose control of our assets. So this is another way to do it. We create a stream of income that we cannot outlive and that will go up over time, but we don't lose control of the assets. It's very important to us. Here's the other thing that can happen with annuities. And we've talked a lot about this, but it also has a long-term care benefit to it or chronic illness rider to it. So that can be part of what you're doing is saying, look, if things really go south on us in our health, we have a way to pay for some of that without having to go through a Medicaid spend down perhaps. So it can do that. You can create that. It's also great legacy planning because any money left over always goes to your beneficiaries. It's not lost. So if this sounds like something you'd like to learn more about, I'm not saying you have to do it. I'm just saying you have an interest in learning more about this. Give us a call, 616-301-2581, 616-301-2581, or go to our website, cornerstone-rp.com. We'll help you. We'll lay out all the ifs, ands, and buts, all the good stuff, all the bad stuff, all the stuff when it comes to how do you use life insurance or principal protected annuity in your retirement accounts? How do you use them to maximize what income you can get, but also put a floor, so to speak, on what's the worst case scenario for a terrible financial issue to happen in your life? What can that be? It could be a stock market collapse, sure, but it can also be a major health occurrence. And sometimes we overlook that. That can sometimes be more expensive than a market collapse. So it can be fashioned in a retirement plan that gives you all the income you need in retirement. So you can retire, but it puts a floor or protects some of it so that if something terrible happens, you're not going to have to go back to work. You're not going to have to reduce your lifestyle. You're not going to have to say, no, we can't do this anymore because we just don't have enough money to do it because of whatever happened to us in the market. So if these are concerns of yours, if this is something you'd like to learn more about, give us a call, 616-301-2581, 616-301-2581. Go to our website, cornerstone-rp.com. We're more than happy to help you understand these things. I think sometimes we underestimate how smart we are, Sometimes I think, well, I don't understand this, I don't understand that. But when I'm able to focus on something and somebody helps walk me through things, technology is a big one. I still don't know what all the buttons on my TV flipper do. I really don't. But I'm learning. I'm starting to learn a little bit. And I'm almost to the point now where I really wish there weren't so many buttons because life would be easier. But the more I learn about that, the more comfortable I am and the more I see how it can help me. It's the very same thing in retirement planning. The more you learn about different kinds of accounts, the smarter you are in creating, with our help, an income retirement plan that will work for you. Good stuff, bad stuff, good times, bad times. That's the key, isn't it? How do we get through the next 20 to 30 years in retirement and we get through in a way where we'd be able to enjoy it, our lifestyle didn't change, and we're able to weather the good times, the bad times, because we know some interesting things are coming down the road. I have not talked to a single client over this past year or new people that we meet who don't have a sense of, oh boy, I don't know what's going to happen, but I'm not sure I'm going to like it. So that's there. We can help kind of minimize those feelings that you have. Give us a call, 616-301-2581, 616-301-2581. Go to our website, cornerstone-rp.com, put your information in there. Tell us what you want to learn, and we can help you. We can absolutely help you.
616-301-2581, 616-301-2581. Ron, as you were speaking about the protections that these vehicles can provide, it made me think that our money really does represent our sense of financial security. And that lump sum that we've saved, we've accumulated, it makes us feel secure. But even that needs protections. We need to have some protections in place for the sense of security that that lump sum is creating. We don't want it to disappear or be washed away without us having anything to show for it. And so we should place some protections on that, because that is where we get our sense of confidence in our lifestyle and our quality of life from. And that on the day that we retire, we may feel like, hey, we don't need life insurance as part of our plan because we look at that big lump sum that's sitting there. But for many, over the years, that has been spent down, or market downturns have taken some of it away. We have not put in place that protection for lifetime income. And so maybe 5, 10, 15 years after retirement, we're thinking to ourselves, man, we really should have an additional component of life insurance to protect our loved ones. It's not too late for that consideration. A lot of people may think that, oh, because years have gone by, it might be too late for me to put those protections in place. But that is not the case.
It really isn't, because there was an interesting article that came out last week, and I think we talked about it in the program, that half the people retiring at age 65 are probably going to live to between 89 or 88 for guys and 89 for women. So you think about that, well, that's a 25-year retirement plan. Half of us are going to get there. Now, there's a 25% chance that one of those clients, one of the couples, man or woman, is going to live to be 97. So when you look at retirement, it could be a 25 to 30-year piece of time. That's a long time to be in retirement. That's a long time for financial things to go sideways or go up, go down. It's a long time for things to grow. It's no different if I think I'm going to, I got a 30-year retirement, than if I'm 40 years old right now thinking, okay, I can start saving. I'm going to work until I'm 70 and I'm going to save. The time is what's the issue. Whether you're thinking about a 25 to 30-year time in retirement or 25 to 30 years before retirement, you have options and opportunities to create the most solid kind of retirement plan capable, available to you right now. Because think about this, what's going to change that we know over time? We know, number one, that inflation is going to be a problem. It's a bigger problem now than it has been. And it's going to continue to be an issue. It never goes away. We know that the tax rules are going to change. We have a government that's printing money faster than they can spend it. It's going to change. Taxes have to change. So we're going to pay more. So the more money we put into 401k plans and IRAs, accounts that have never been taxed, but are going to be taxed to the full power of the tax code. We know that if we have $1 million in an IRA or 401k, probably 30 to 40% of that is going to be given away to taxes. So we really don't have that kind of money. That's why we talk so often about right now is the greatest time in your life to create Roth accounts, or to create accounts like a life insurance contract, cash value, that create tax-free income. So there's a lot of things going on in our world today. A lot of it's going to have a bigger impact on retirement tomorrow or the day after than it is today. We can help you kind of take a look at the future, say, what do we have to be concerned about? And what can we do about it? I tell people, we live in Michigan. Here it is, September. What we know for sure is that January and February is coming in Michigan. That means Probably going to get colder, probably going to have snow, probably it's going to be ugly because that happens. But we plan for it. We've been through this. This is not our first rodeo in Michigan. So we've been through this with retirement planning. Ladies and gentlemen, retirement planning is not our first rodeo. We've been doing this since 1994. So if anything we've talked about in today's program, how do you make tax-free income a reality? How do you take care of the long-term care issues potentially in your life? How do you create a lifetime income plan that works? Good markets, bad markets. How do you create protected principal, protected cash flow? We can help you with all of that. So give us a call, 616-301-2581, 616-301-2581, or go to our website, cornerstone-rp.com. Put your information in there. We'd be more than happy to set up a phone call, a Zoom call, or in-person call to help you gain understanding about all the options out there. Because there's a lot of things available to you that a lot of times other advisors don't talk to you about. We tend to cover the whole gamut, everything. So you can have all the information in front of you to make really great decisions. So call us again at 616-301-2581. Go to our website, cornerstone-rp.com. We're more than happy to help you.
616-301-2581, 616-301-2581, cornerstone-rp.com, cornerstone-rp.com. One more time, 616-301-2581. Ron, we always appreciate your insight, your guidance, and perspective here on Your Course to Retirement.
Well, this has been fun for me. I hope there's a nugget out there for everybody who listened. In the meantime, you have a blessed Sunday, and I'll talk to you next week.
Tune into Cornerstone Retirement Partners' full radio program, Your Course to Retirement, Sunday mornings at 9 o'clock at News Radio WOOD, or visit cornerstone-rp.com for many valuable resources, including those mentioned on this show and other great episodes of Your Course to Retirement.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor.
Ed Slott's Elite IRA Advisor Group is solely an indication that the financial advisor has attended training provided by Ed Slott and Company, passed biannual examinations on material covered at conferences and in webinars, and met other membership requirements, and does not constitute an endorsement of any kind. Ed Slott's Elite IRA Advisor Group members pay a fee for the educational programs that allow them to be included in the Ed Slott's Elite IRA Advisor Group. Membership does not guarantee investment success. Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services.
Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals or growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes.